Most retail investors and traders are not losing money in the market because they are unlucky. They are losing money because they don't have an edge in the market. They are just guessing, reacting, and consuming noise. So today, let's try to fix that. There's a concept used by the greatest quantitative trader of his time called Edward Thorp. He built a system which beat the casino, and later he beat the stock market as well. And everything he did came down to one idea: finding his own particular edge. No hope, no prediction, an edge. Edward Thorp defined edge as anything that can shift the odd in your favor. That's it, not guaranteed profit, not winning every trade, but over time you win more than you lose. And this idea is not limited to trading. In casino, the house always has an edge. That's why the casinos makes money consistently. But Thorp asked a different question. What if I reverse the edge through card counting in blackjack? He built a system where players had an advantage to play. Same game, same rules, but the maths worked in his favor now. In the stock market, the idea is somewhat similar. Your edge means you earn higher return than an average investor, or you can earn similar returns with lower risks. Thorp's hedge fund did exactly the same. For nearly 19 years, it delivered double the market returns with significant less volatility. While the markets have dozens of losing months, his funds barely has any. That's what an edge looks like in a practice. What's interesting is he didn't stop just at finance. He applied the idea of edge to life itself. If you're a non-smoker, you add years to your life. If you do exercise, you improve the quality of your life. If you use safer means of transport, you reduce the risk of accidents. These are not random choices. These are decisions that stack probabilities in your favor. And that's exactly what trading and investment should be. Now let's bring this back to you. Most traders and investors are doing the opposite. They follow tips, copy influencers, react to news. None of that creates an edge into the market, because none of that changes the probabilities of you winning more than other person. So how do you actually find one edge? Edge can be as simple as one simple hypothesis you have. For example, if prices cross 200 days moving average, the market is particularly bullish. That is one kind of edge that you have based on your observations. Step 2 is define your edge clearly. When to buy, when to sell, how much risk you can take, how much position sizing, how much to buy. Step 3, you need to test your edge if it actually works based on historical data. Take the historical data and run your rules on years of market behavior. Analyze your result. Does your edge actually works? Does it make money for you in the long run? And does it survive the crashes? This is where most people fail. They stop at ideas, but the real edge only exists after testing. Here's the truth. Most strategies don't work. And that's good, because every failed strategy gets you closer to the one that actually works in the market. Edge cannot be discovered in just one attempt. It is built through multiple iterations of testing and experimenting with the markets. So stop asking what should I buy next and start asking what systems gives me statistical advantage over time. That shift alone will put you ahead of all the retail traders and investors. Because in the end, markets are not about being right. They are about being consistently better rather than being random. And that only happens when you have edge in the market. In the next video, I will discuss how you can actually go into the markets and look for this smaller edge that stack probabilities in your favor. What do you think? Is edge actually needed in trading or investing? Or you just want to follow the tips and tricks of other traders because it's not going to work over a longer period of time? It can generate profits in the short term, but on the longer term, if the strategy doesn't work, then it's doomed to be failed after some time.